The last chapter summary of Chapter 42 is titled Investor Protection, Insider Trading, and Corporate Governance. So in 1933, there was the Securities Act of 1933, which basically it governs the sales of stocks. So a security or stock, by definition, can be preferred or common stock, bonds, warrants, options, puts, calls, notes, instruments. So that is what is all involved. And it includes an investment contract. So when a person invests in a common enterprise expecting profits from another person's managerial efforts, it's considered a security. They must be registered and included in the contents of the statement. So the person investing must know what's offered, the risk factors, and management involvement within the company. There's also the Securities Exchange Act of 1934, which involved regulation of security exchanges, brokers, dealers, and national securities. Section 12 of that considers Section 12 companies, which just basically involved companies with more than 10 million in assets or 500 plus shareholders. So these are the very big companies that involve a lot of people. So they just have more regulations and require more security exchange. This authorizes the SEC to engage in market surveillance. So this act implemented the SEC's laws and regulations through what they do and what they see of these big, large companies that are selling securities. So with that comes a lot of fraud, and this is what it was meant to avoid. So types of fraud that is most likely to occur is material misrepresentation, a wrongful state of mind, which is a scienter, reliance, economic loss, causation, which is could be the connection between a misrepresentation and the loss. So any fraud within the company is regulated through this, and the SEC oversees all of this. It also includes laws about insider trading, which is when a person will buy or sell based on information that is not known to the public. So this happens a lot if I work for a company that just announced that something really bad is going to happen, but it's not public knowledge anymore, and I sell all my stock in it. That would be insider trading, which is illegal. Proxy statements. So these are also regulated by the SEC and what the content that goes into those. And then there's Ponzi schemes, which is also fraudulent investment operations. So that involves when one person is investors are pouring into this, but their returns are coming from other investors. So that's kind of just money that's not really there. It's just constantly being floated through. So this happens a lot, and there's documentaries on it I've watched, or just like there's a lot of examples that have happened that's very illegal, and there's a lot of punishment for them. State security laws, which are also known as blue sky laws, regulate the offer and sale of securities within its borders of the state. So there's disclosure requirements and anti-fraud provisions within the state, also on top of the federal provisions. The concurrent regulation, so that's just a rule that you must abide by state and federal, but SEC has the exclusive power to regulate because there's a lot of conflict to say a state allows it but the government doesn't. Well, the SEC is oversees it all. As for corporate governance, it involves the relationship between a corporation and its shareholders. So it must align the interests of officers and shareholders, and this includes most publicly traded companies that are owned by shareholders. So basically, it just promotes accountability, and you do that through auditing, reporting of the financial conditions, just so it's accurate and everyone knows the right information and it's all true. So this also involves legal protection for the shareholder, so they can't be lied to. They're protected if they don't know what the officers are doing. Also, in order to protect this, a lot of companies issue a board of directors which oversee the staff, the officers, and also are in connection with the shareholders. So the Sarbanes-Oxley Act was just in 2002, so pretty recent, and it was just an act that increased corporate accountability. It just gave more strict requirements and harsh punishment if the corporate governance is abused, which it has been, especially in accounting with lying of financial statements and other things like that. So basically, the CEO and the CFO, Chief Financial Officer, have to certify the accuracy through the financial statement. So everything has to be proven, basically, in order to make business decisions.